We are watching Bitfarms Ltd, ticker symbol BITF, trading live right now at $3.31 per share, down approximately 5.16% on the intraday chart as the market digests a significant pullback in the broader cryptocurrency sector. The volatility we are witnessing this morning is palpable, with the stock gapping down at the open and struggling to find a support floor near the $3.25 level. Volumes are already surging past their 10-day average, indicating that both institutional capitulation and retail panic are fighting for control of the order book in these opening hours. While the average observer might look at this red candlestick and assume it is merely another day of standard volatility in the crypto mining space, the reality of what is happening with Bitfarms today is far more nuanced and, frankly, critical for anyone holding or watching this equity. The expectation from the retail crowd, often active on platforms like Robinhood stock trading apps or discussing moves in SoFi Invest forums, is that Bitfarms is simply a high beta proxy for Bitcoin. The narrative is simple. If Bitcoin drops, Bitfarms drops harder. And if Bitcoin rallies, Bitfarms moons. That is the expectation. But the reality I want to expose to you today is that Bitfarms is currently undergoing a fundamental identity crisis that is decoupling its long-term value proposition from the immediate price action of the underlying digital asset it mines. We are not just looking at a miner reacting to spot prices. We are looking at a company attempting a high-stakes pivot into high-performance computing and AI infrastructure while simultaneously fending off the lingering governance shadows of the hostile Riot platform's takeover attempt that dominated headlines just months ago. This is not just a buy-the-dip scenario, it is a stress test of their entire corporate strategy. To understand why this $3.31 price point is so pivotal, we have to look at the immediate catalyst driving today's red tape. Bitcoin itself has broken key support levels, sliding below $86,000 this morning after failing to hold the $91,000 range over the weekend. This 6% drop in the underlying asset has triggered a massive leverage flushout across the sector, wiping out over $500 million in long positions in a matter of hours. For a miner like Bitfarms, whose revenue is mathematically tethered to the price of Bitcoin, this immediate revenue compression is terrifying for short-term traders using interactive brokers' trading platforms who prioritize immediate cash flow metrics. However, the market's reaction to Bitfarms specifically has been more violent than some of its peers like Marathon Digital or CleanSpark, and that excess volatility is where the opportunity and the danger lie. The market is pricing in a fear that Bitfarms' aggressive capital expenditure strategy aimed at upgrading their fleet efficiency to 19 watts per terahash and expanding their HPC capabilities might leave them cash poor if this crypto correction deepens. Investors using Schwab Intelligent Portfolios or similar automated risk management tools are likely seeing alerts trigger today because the correlation breakdown is becoming evident. Bitfarms is being punished not just for Bitcoin's price, but for the execution risk of its own transformation. Let's talk about that volume. We are seeing massive blocks being exchanged at the $3.30 level, which suggests that a large fund or institutional player might be reevaluating their exposure. Unlike individual brokerage accounts where you might sell a few hundred shares on a whim, these blocks represent a structural vote of confidence, or a lack thereof. If you are sitting at home managing your own self-investing strategy, perhaps through Fidelity Investments or checking your Fidelity mobile app, you need to look at the depth of the market right now. The bid-ask spread is widening, which is a classic sign of thinning liquidity during a sell-off. This creates a dangerous environment for market orders, but a potentially lucrative one for limit orders if you believe the structural thesis remains intact. The expectation was that the post-halving economics would force smaller miners out of business, leaving giants like Bitfarms to feast on the reduced difficulty. The reality we are seeing today is that the efficiency gains from new hardware are being offset by the sheer cost of power and the massive capex required to pivot into AI data centers. Bitfarms is betting the farm, pun intended, on becoming a hybrid entity, part Bitcoin miner, part AI infrastructure provider. This is similar to the narrative we saw shift with Nvidia stock years ago, where it went from a gaming card company to the backbone of the AI industry. Bitfarms wants to be the infrastructure layer for that shift, but the market is skeptical today, punishing them for the capital intensity required to get there. You have to remember that this company has been through a war recently. The hostile takeover attempt by Riot Platforms, which was settled back in September 2024, left scars on the stock sentiment. Riot had accumulated a massive stake, pushing for governance changes and attempting to acquire Bitfarms for around $2.30 a share back then. While Bitfarms successfully defended their independence and the stock traded significantly higher in the months following, reaching highs near $4.89 just last week, the specter of that conflict lingers. The poison pill defense they used, diluting shares to prevent a takeover, saved the company but also expanded the float, making each share you hold slightly less potent in terms of ownership percentage. Today's drop to $3.31 brings those governance anxieties back to the forefront. Investors are asking, if they stayed independent to unlock value, where is it? The reality is that value is being built in the background, in the megawatts of power capacity they're securing in Pennsylvania and Paraguay. But the market has zero patience for background building when Bitcoin is dumping 5% in a single morning. One of the most fascinating aspects of Bitfarms' current situation is their fleet efficiency. They've been aggressively upgrading their miners, aiming for that 21 exahash per second target. In the mining game, your efficiency is your moat. If you're mining at 30 watts per terahash and your competitor is mining at 19 watts, you die when Bitcoin drops, and they survive. Bitfarms is sitting in that elite tier of efficiency, which means that fundamentally they should be profitable even at these lower Bitcoin prices. But the market is forward-looking. It is looking at the skyrocketing energy costs in key jurisdictions and the regulatory headwinds in places like Argentina and Canada. This is where the smart friend analysis comes in. Don't just look at the Bitcoin price, look at the energy contracts. Bitfarms has some of the best hydropower contracts in the industry, which insulates them from the spiking natural gas prices that are hurting their competitors in Texas. This green energy mix is a hidden asset that algorithms on investing sites often miss because they are too focused on the raw BTC correlation. If you are using a SoFi trading platform or researching via Fidelity wealth management tools, you might not see Energy Mix Alpha listed in the metrics, but it is the single most important factor for long-term survival. Let's pause for a second and gauge the room. Comment below how many shares of Bitfarms you currently hold and at what price did you enter. Are you underwater from the $4 range, or are you sitting on a legacy position from the $2 days? I want to know if you are treating this as a trade or an investment. Now consider the broader tech context. When we talk about Tesla stock or Apple stock, we're talking about companies that control their entire ecosystem. Bitfarms does not control Bitcoin. They are price takers, not price makers. This is the fundamental vulnerability of the business model and precisely why their pivot to high-performance computing is the most critical story to watch. They are taking their massive power capacity, power that is increasingly scarce in a world hungry for AI training clusters, and leasing it out or building infrastructure for AI clients. This puts them in the same conversation, albeit tangentially, as the giants driving the Nasdaq. If they can successfully convert even 20% of their power capacity to HPC clients, they stabilize their revenue stream. Instead of the wild swings we see today, they would have steady contract-based cash flow, similar to a REIT or a utility company. This would justify a much higher multiple on the stock. The expectation is that the transition is easy. The reality is that data centers for AI require 99.999% uptime, redundant fiber lines, and cooling systems that are vastly more complex than the rugged open-air setups used for Bitcoin mining. The execution risk here is massive. If they fail, they burnt cash for nothing. If they succeed, the stock at $3.31 is a steal. We also need to discuss the institutional landscape. Recent filings show that major players like Vanguard and BlackRock have been adjusting their positions in the crypto mining sector. When you see activity on Fidelity ETFs or Fidelity mutual funds that track the digital asset space, you are seeing the aggregation of these institutional moves. For Bitfarms, the institutional ownership has been volatile. The settlement with Riot saw some arbitrage funds exit, leaving a gap that needs to be filled by long-term believers. The volume we are seeing today, over 10 million shares traded in the first hour alone, suggests that this rotation is happening in real time. Weak hands who bought the breakout above $4.50 last week are folding, and deeper-pocketed value investors might be stepping in at the $3.30 support. This is the classic transfer of wealth mechanism that defines the stock market. If you are using Robinhood crypto to trade the coins, you understand the volatility, but holding the equity of the miner introduces operational leverage. A 5% drop in Bitcoin can lead to a 10% drop in cash flow margins for Bitfarms if their energy costs remain fixed. This operational leverage cuts